Thank you very much for joining us today on the Small Sum Lending Pilot webinar. We'll be sharing evidence, insights, and action, and talking a little bit more about how you can get involved and the eligibility for potential lenders interested in partnering with us. I'm really pleased today to be joined by a panel of speakers who I'll be handing off to over shortly. But just to let you know what you can expect from the webinar today, we'll be talking about what the Small Sum Lending Pilot is, who it's for, the lessons we've learned from the banks and lenders we've spoken to in the US and who we've spent time with and who've been inspiration for some of this work, the way that we are coming together with the regulator, government and industry to try to make something happen, and the scale of issue driven by the evidence that we've seen and the insights we've gathered on the credit supply and demand. And then we'll finish off the session with talking about the details of how exactly you can get involved and what is on offer. What's particularly exciting about being here together today is the government's national strategy for financial inclusion, which directly named small sum lending as one of the key deliverables under the strategy. And so with that, I'm really pleased to be able to hand over to our CEO, Kate Pender, who was also the chair of the credit subcommittee for the Financial Inclusion Committee. Kate, over to you.
Thanks very much, Deanna, and welcome to you all today. Really excited that we've got this time together to explore small sum lending. As Deanna said, I chaired the Access to Credit subcommittee working to support Treasury in its development of the National Financial Inclusion Strategy. And that credit focus recognised quite how big the challenge is in the UK for millions of people. At Federal Finance, our research shows that there are 20 million people in financially vulnerable circumstances, and work that LEK published a couple of years ago indicated that roughly 16 million people have inappropriate or inadequate access to credit. There is, broadly speaking, a £2 billion gap in available credit, which could be commercially viable and compliantly delivered. The lack of that provision is holding people back. Small sums of credit help people get into opportunities and to embrace them. And without that access to credit and all of the other parts of the financial inclusion jigsaw that we need to pull together, the UK is currently missing out on £6.4 billion of economic growth every year. From our own work, we see 1.9 million people borrowing every year from unlicensed lenders and loan sharks. We also know that there's a big chunk of the population who are currently relying on buy now, pay later, and who probably won't have that access once regulation comes into effect. And to be really clear, we applaud the regulation coming, but we are concerned about the impacts on people who might not have any alternatives. Federal Finance has been going since 2019. We're a systems change organisation, very much focused on how we get financially inclusive outcomes for our wider population. Much of our early investment went into credit unions and community development finance institutions. These are vital organisations, and we know that their lending, which is often at a much smaller average principal than is the norm in mainstream finance, can make a real difference to people's lives. These organisations are vitally important, but it's important to also be realistic that they're very small in comparison to the scale of the challenge. In 2025, the combined lending across the CDFI and credit union sector touched about 1.3 million people in financially vulnerable circumstances. And that's a fraction of the numbers who desperately need access to a small loan to get them past a bump in the road. We know that if the CDFI sector continues to grow at a pace that outstrips the rest of the market, it would still take another decade before they were delivering enough credit to solve that £2 billion gap that I mentioned earlier. The credit union sector naturally grows more slowly, and we're thrilled to be supporting its growth plans through our Credit Union Transformation Fund. But more needs to be done than these two types of organisations can deliver. We need collectively to solve that gap. And that's why we were really excited to learn about what the US banks are doing to tackle a similar problem. 6 of the 8 largest US banks now offer small sums of credit to people who need it most. And we've heard from them about how it's a product that has enabled them to lend to people they wouldn't previously have served, and how those people have then gone on to demonstrate that they are good payers and are capable of taking out further products with those banks. What you're going to hear about today are our plans to adapt and to replicate the success from the US. And that proposition is backed by really robust research from Experian, from Ipsos, and from ClearScore. In the US, the small dollar loan scheme uses current account data in the main to underwrite decisions. And we know from ClearScore and Experian's evidence that open banking in the UK can play a similarly liberating role in unlocking credit. We also know that it can enhance the precision of underwriting, ensuring that unaffordable lending doesn't happen. So we're really excited today to be sharing with you our plans for a small sum lending pilot in the UK. A big shout out to all of those who were part of the Access to Credit subcommittee and contributed to the proposals that made it into the National Financial Inclusion Strategy. And equally, huge thanks to Treasury for its role in convening us, and to FOS for their support, along with the FCA. We know that there's a significant untapped market potential here, and we also recognise that it's only mainstream finance that has the breadth and the capacity to fill it. Meeting the needs of millions of people requires scale, and it requires large institutions, high street banks, to participate in a scheme like this to make a really big difference. I want to be really clear, Fair for All Finance is still deeply committed to the community finance sector. We continue to back CDFIs, we continue to back credit unions. We think the work that they do is vital. But we also recognise that mainstream finance needs to step up and step into parts of the market that it hasn't currently been serving. So you'll hear today about how we can help run a pilot that enables mainstream lenders to try out this new proposition, and the commercial and wider support that we've brought to bear to make that true. I also just wanted to recognise the really practical help that we've had from the FCA, and you'll hear about that later on, but also the support we've had from FOS. We know that FOS has been setting out its plan on differentiated case fees, which could include lower fees for lower principal loans being considered later in the year. And we know FOS also plans to publish its decision-making frameworks for assessing complaints. In particular, we're looking forward to collaborate with FOS on how these small sum loans will be considered in this wider decision-making framework. I'm also really thrilled to say we are in the final stages of negotiating with the first bank who wants to deliver the small sum lending pilot with us. But one is not enough. So this is a great opportunity today to hear about how organisations like yours can work with us to demonstrate how small sum lending work can really make a difference in the UK. I'm thrilled to be here. Thank you for joining us. And I'm now going to hand over to Sophie McNair, Head of Financial Inclusion and Financial Capability and Consumer Debt at the Treasury. Sophie.
Thanks, Kate. And great to be here today and not see you all because we're on a webinar, but great to speak to you all. So as Deanna and Kate have mentioned, we published a financial inclusion strategy in November, which set out the government's plan for improving financial inclusion across the UK. That also included the Economic Secretary to the Treasury's vision, which is set out in the strategy, which is a financial services system which works for everyone, where people can access the products and services they need to build their financial resilience and achieve their goals. And as you heard from Deanna, affordable credit was one of the 6 key pillars of the strategy. So I think the sort of context to that is we know that credit use in the UK is high and that lots of the market is served well, But we know that there are real gaps, as Kate's mentioned, and solving financial exclusion means facing into the areas where gaps remain and working together to try and address them. I think experience from the community finance sector demonstrates that the impact of a small loan can be anything but small. It can be the difference between coping with a short-term shock or potentially falling into financial difficulty. As the recent credit union common bond reforms demonstrate, we in Treasury will always champion the community finance sector. But as was noted in the strategy, and as Kate mentioned, I think we recognise that community finance cannot meet the needs of underserved consumers alone. This is a challenge which the sector as a whole needs to rise to meet. And that's why we think small sum lending matters, and why this pilot presents a significant opportunity to build financial resilience by supporting people to smooth income volatility and meet unexpected costs. And also, I think really importantly to us as Treasury, catalyse innovation by allowing firms to develop products which better fit the way people live and budget. So I think we'd see there's a kind of question for firms here. Do you think your current product offering serves your customers as well as it could? Are there any gaps that you're trying to close? And if so, could this pilot be part of closing those gaps? We understand this is a challenging part of the market to serve. I think if it wasn't, then we wouldn't be here today. We wouldn't be doing a financial inclusion strategy. But we think that's where dormant assets funding can play an important role in reducing risk and enabling the testing of new solutions. So I think the ask from us at the Treasury is that firms consider the opportunity that this pilot could provide to innovate to deliver better solutions for your customers. And I think with that, I'm handing over to Mark from the FCA.
Thanks, Sophie, and good afternoon all. Firstly, I'd like to say thanks to Kate and the team at Fair for All Finance for the invitation to participate today. I'm the Head of Market Intervention and Consumer Lending at the FCA, which means I've got responsibility for supervision of high cost and mainstream lending alongside credit unions. I'm also responsible for the supervision aspects of the FCA's access to credit work. And we recognise the importance of financial inclusion to individuals and the economy as a whole. And while we don't have formal powers to direct access, we do have a suite of regulatory tools that we use to ensure that there's a well-functioning credit market that serves a wide range of people, including those who use credit to manage fluctuating incomes and cope with unexpected expenses, car repairs, washing machine breaking down. We're pleased to be part of the Government's Financial Inclusion Committee as well, and we sit in each of the 3 subcommittees, including the Access to Credit Committee chaired by Kate. Our discussions in that group led to a list of recommended interventions, and it's good to see that many of these are included in the Government's Financial Inclusion Strategy, including Fair for All Finance's pilot of a small sum lending scheme, which you'll be aware aims to increase access to credit for those who are underserved. We agree that access to credit remains a challenge for some consumers. Our latest Financial Life survey told us that 3.2 million adults had applied for credit and been refused in the last 2 years up to May 2024. That was 22% of all adults who had made an application during that period. And while some managed to get credit from an alternative supplier, 45% of those declined, equating to 1.4 million adults were unable to get the credit they needed at all, with those most likely to be declined, including the unemployed, adults with low resilience, and adults aged 18 to 24. So we want to see consumers provided with credit that they can afford to repay, but it's also important to recognise that for some consumers, credit is not the answer, and signposting to debt advice or to income maximisation tools may be more appropriate. We took over responsibility for consumer credit in 2014, and since then we've concentrated on raising standards. We introduced the high cost short-term credit price cap, which has benefited around 760,000 consumers, saving them around £150 million annually. We strengthened support for borrowers in difficulty and acted against firms not getting it right. Both the senior managers and certification regime and the consumer duty have also built a strong foundation for a fairer, more resilient and more innovative consumer credit sector all round. And some firms have thrived adapting to these reforms. Others ended up leaving the market, particularly high-cost credit firms. And while that's reduced some harmful practices, it's also made access to credit more difficult for some, highlighting the complexity of consumer protection that remains at the heart of our work. We have and we will continue to step in to protect consumers where necessary. However, we're doing what we can to encourage firms to enter the market. We're providing extra support through our pre-application support service for firms seeking regulatory approval, and we're letting more firms know that we are minded to approve their applications for authorisation when we think they can meet the required standard. This will allow firms to seek investment with confidence that they can secure regulated status. We're also changing the way that we communicate with firms through our new annual regulatory priority reports, which replaces over 40 portfolio letters with a clear sector-based guide that brings together a supervisory and policy focus, including in consumer finance, where our priorities underpinned by the consumer duty include access to well-designed fair value credit that consumers can afford to repay, effective support for those in debt, and timely redress when things go wrong. And we want to see a flourishing and sustainable open banking ecosystem that drives competition, innovation and growth in the UK and empowers consumers to access new and better services than they do today, improving their financial lives and driving innovation and growth. We recognise that ensuring access to credit that people can afford to repay is a complex challenge with no single solution. We encourage innovation and offer the support of our innovation services and regulatory sandbox to test new products in the interest of consumers and to support financial inclusion. That's why we welcome initiatives such as this small sum lending pilot, and we're keen to understand its impact on consumer outcomes over time. The publication of the government's financial inclusion strategy, alongside the significant work already underway in access to credit, is an important step forward. But the levers sit across a range of organisations, and we need to continue to work together to ensure that the credit market works as well as it can for individuals and communities in the UK. Thank you.
Thank you to Mark and to all our speakers. I think they've set out really clearly the amount of encouragement and support there is for potential lenders who want to get involved. But where did we get inspiration for this small sum lending product? I'll tell you a little bit about what we've learned from the small dollar loan scheme in the US. As a systems change organisation, we're always looking to examples internationally and abroad to see if there's anything that we can learn from to apply to the UK. What we've learned through our work in the US and through the contacts and relationships and networks that we've made there is that the credit market has some similarities to the UK, and equally there are millions of people that have been locked out of access to mainstream credit in the US. But in recent years, only in 2020, a major programme changed a lot of that. So the major banks worked closely in collaboration with the regulators and think tank and consumer groups to put out a product which is now referred to as a small dollar loan. A small dollar loan is, in some ways, what it says on the tin. It's a product that's below $1,000. It's a product that is predominantly supplied by the big mainstream banks, so the names the like of Bank of America, US Bank, Wells Fargo. This product is different, though, to what we've seen before. And that key difference is banks do not look at credit bureau scores and rely on customers' transactional data to make their assessment of affordability and credit risk. This has been a real game changer for millions of people who have been locked out of mainstream finance. So to give you an indication of scale, and I think we all know that US sort of does things bigger, but the scale is still really impressive in terms of what they've been able to achieve in a really short amount of time. So at the time of publishing the data, there were 800 million loans outstanding only 2 years into the pilot and the work that was carried out, with millions of borrowers served that were previously excluded from this type of lending. What we've heard from conversations with our US counterparts, both from banks and the consumer groups, is that this program has led to displacement of payday lenders, that it's been a paradigm shift in financial inclusion. And what's been really interesting for us is to hear from some of the banks directly about their surprise that they were able to serve so many more customers than they thought they could previously, and learning about the performance on some of those loans being significantly better than what they anticipated. We'll be sharing these slides after the webinar, so you can read in a little bit more detail some of the feedback that we've collated. But more specifically, I'd like to draw your attention to a key few things that we've learned from the pilot on the next slide. And that is that this product works to serve customers really well, and there've been some assumptions that have been debunked about the types of things that customers are spending. So key banks CEO spoke about the fact that she was really interested to learn about the types of things that people were borrowing for, which won't be a surprise to many of us, but it was a surprise for key bank. That the delinquency rates and so the performance on the loans was between 7 to 12%. Again, figures that might surprise lots of us on the call, or lots of people that have been less familiar with this. And that is data that's been pulled by Federal Reserve and that is publicly available as part of their impact study, which we can also share separately. And that banks have been able to deliver thousands and thousands and thousands of new loans, meaning that it's a product that is commercially viable for them to continue to deliver even now, 6 years on. So these are some of the data points that we think really highlight the opportunity there in terms of the size of the market. But let's talk about who is this product for in the UK, and the thing that we really care about, which is serving people in financially vulnerable circumstances. We've spent lots of time talking with people all across the country, not only for the small sum lending pilot, but also for our other pieces of work in terms of trying to understand who credit is for and where it can be helpful. We all know, and I think has been repeated by Mark, Kate, and Sophie, and myself here too, that credit absolutely is not the right answer for lots of people. But for many people, it is a really useful tool to manage monthly liquidity. Sometimes it's not always monthly. We know there's lots of people that are on volatile incomes, and that's also part of the way that people can sometimes manage their finances. So what we've heard people say is across all different types of financial needs, there's different ways that they utilize credit. So we've highlighted in the next few slides the different segments and the different people who we've interacted with and the stories that they have about credit. So maybe if I just zone in for just a moment on the next slide on Chloe. Chloe is 28. She lives in Manchester with her partner. She uses borrowing as a way to support her and her husband and the way that they manage their childcare. She told us that although she knows that buy now, pay later is really readily available, that it makes her feel a little bit uneasy and she sees it as an easy way to get into debt. She would really like to be able to borrow from her bank and to be able to see the lending in one place. Now, Chloe is just one of many, many stories in the way that people use credit and the way that it supports their daily resilience. But if we zone out into the macro picture, it's not just about stories of individuals and the credit and the difference that credit can make to them. There's also a very clear market opportunity in terms of the size of the market that's available. If we go into the next slide, you can see that there are some key things that people would like to see in the products, and we would encourage lenders to consider some of these. Those are things like early repayments, being able to build their credit score, to have a structured product, and to be able to, most importantly, borrow from a known provider, example, a bank or somebody, a name that they recognize. Lots of the work that we've done is supported through not just by what we've done, but also by other providers. When we spoke to ClearScore and EY, they confirmed that lots of what we're seeing is also evident in their data. So we've seen that there are millions of people, 3.6 to be exact, who have thin files, meaning that they don't have much of a credit history and it's difficult for them to be able to evidence that they would be good payers. And equally, there are millions of people who have adverse credit, meaning that they've had an experience in their life, which means that at one stage they might have been late on a payment or defaulted on a payment. Oftentimes, that is not reflective of the person that they are today and their financial life that they lead today, but it does impact their ability to credit. And so, together, collectively, what we're seeing here is a collection of individual stories that also lead to a really significant market opportunity for the right lenders to serve this customer market. With that, I'm going to lead over to our credit market lead, Neil Alexander. He will talk you through some more of the data. Over to you, Neil.
Great. Thanks, Deanna. Hello, everybody. So what is the evidence that draws us into thinking that small sum lending might be needed? We've got our own evidence from our own commissioned research and insight. We've got work undertaken by Ipsos. We've got ongoing work through a data feed that we get quarterly from a supplier called Infineon. We've got some of that evidence here in the next sort of 5 or 6 slides. But I'm also going to reference some work that's already been highlighted by Kate and others, the ClearScore and EY in their recent report, which was called The Future of the UK Credit Market. And we've got evidence, of course, from the FCA and from the ONS, all of which I think collectively supports a contention that there is a gap. There's a gap here that could and potentially should be filled. Mark said it, Deanna said it, it bears repeating. Credit where it's appropriate, credit where the needs of the borrower align with the motivations of the lender. That doesn't always happen, does it? The needs of the borrower don't always align with the motivations of the lender. So credit can be a good thing in people's lives. It can be helpful. It smooths expenditure. All of the things we know helps with bigger purchases, and it generally helps people find solutions to problems. Of course, absolutely not always the best thing, but in the right circumstances, credit, particularly small sum credit, can be a very good thing. So let me take you through the slides. This slide looks a bit busy. I'll talk you through it. This comes from our Ipsos research. We asked over 4,000 adults, 4,132 to be exact, GB adults aged 18 to 75, weighted representative group. And we asked them whether they could meet an unexpected but necessary bill of £500 without borrowing. It's a very similar question to one that the ONS have asked a number of times. Their number, though, is often £850. Ours was £500. The last time the ONS asked if people could meet that kind of unexpected bill, they had a figure of 23% saying they couldn't. Our figure is 25%. You can see that in the column on the left-hand side of the chart. 25% next to the red circle, 25% who say that they cannot meet a bill of £500 without borrowing. And it's higher, of course, for certain people with certain additional characteristics. So far left of the graph, that's that 25% figure. On the far right, you can see a 39% figure. That's lone parents with children. And in the middle of the chart, there's figures for lower income households. Let's look at the next chart. So this is sourced from Infineon. Again, I'll talk you through it. Infineon are a company that specialise in data. They're part of the Quint group, a fintech group that build the tech and the data platforms used by lots of aggregator sites. So we get Infineon from data, from loan comparison, credit decisioning, financial marketplaces. So what you got to know about this is people, real people, online seeking credit. They're potentially typing into search engines things like small sum lending, poor credit history, bad credit loans, that type of thing. So there's 6 columns here. You can see, maybe you can't see, but there is a number at the top of each column. That's the actual number of individuals per quarter, unique individuals per quarter. This chart goes up to the 31st of December 2025, so it's pretty fresh, just a few months ago. Figure at the top of the furthest left column is 668,000, approaching 669,000. That's people. That's 669,000 people. That is the number of unique applications in that particular quarter. In that case, on the left-hand side, that's Q3 2024. And it goes across, if you follow the columns over, to 411,000, just over 411,000 at Q4 2025, so up to the 31st of December. So first thing you know, drop-off. The drop-off in people making applications, that's what it looks like. We'll get the most recent quarter in the coming days, early in April, so we'll be able to check whether there's a pattern developing here. What you may also see in these columns are a tiny sliver of orange in each column. You can see it more pronounced on the left-hand side than the right-hand side. So that sliver is loan offers. 6% it says on the left-hand side, 1% it says on the right-hand side column. So it's a tiny percentage of these applications for credit that are getting loan offers from the various panels of lenders that these figures are sourced from. ClearScore and EY tell us a very similar thing. Their most recent report, the one I talked about earlier, Future of the UK Credit Market. I haven't put a slide up on it, but if you look at that report on page 9, there's a significant drop-off in loans to what they call subprime borrowers. On page 11 of that report, it details what percentage of subprime borrowers the big banks might likely lend to, and that's a very low figure, just 1%. Those columns, again, those 6 columns, the purple bit in the middle, that's alternative offers. They are mostly credit builder products. They don't always have the greatest reputation. In fact, I think the FCA said of credit builders, and I quote, sometimes people borrow, wrong quote, sorry, there is little proof that these products will help improve your credit score or make it easier to get affordable credit. Okay, so just on that last column on this slide, just that last column that says 411,000, let me just unpack that for you in the next slide. If we can get to the next slide, that'd be great. There we go. So this is that 411,000 real applications, real people unpacked. The big orange column, the one that stands out, that tells us that nearly 225,000 people of the 411,000 applications were seeking sums less than £1,000. That's what that tells us. It tells us more than that. It tells us they wanted it in a term under 12 months. If we take the orange column and the teal column that's next to it, very fair for all branding, that tells us that 70% of all applications in the last quarter from data from Infineon wanted under £2,000 and they wanted it on a term under 52 weeks. And you saw from the last slide how few actually get an offer, just 1%. If you go to the next slide, please. So this is again back to our Ipsos research from 2025. And we wanted to know whether sometimes people might borrow more than they actually needed because lenders didn't go as low for them as they actually wanted. So you might have been offered £1,000 as the minimum you could get, but on the sliders and that kind of thing, but you only wanted, say, £700. 8%, left-hand column again, 8% said that had happened to them. That's around 1 in 12 people. Again, certain characteristics, the number is higher or indeed lower. Younger people seem to say this happened to them. Black and Asian people seem to say this happened to them. And people on 0 hours contracts definitely said this happened to them. Next slide, thanks, Kate. So this slide, which doesn't have a title, I don't know where the title's gone and I don't know where the number's gone, but I'll tell you about it. So this is 2 pie charts, again from the Ipsos work. So we asked a raft of questions on whether people borrowed from their friends or borrowed from their family. And more than that, we asked whether the amount that they borrowed was under or over £250. It's an arbitrary sum, it's a small sum, £250. When it was combined, 20% of our whole survey said that they had done this. They borrowed from their friends or family. That's double what the FCA findings were in their Financial Life survey. So again, just look at the column on the left is friend, the pie chart on the left is friends, the pie chart on the right is family. So in detail, just look at that orange segment. 9% of those who told us that they'd borrowed from their friends said that the sum they had borrowed was under £250. That's the orange segment. On the right-hand side, the orange segment is 14%. 14% of people said they borrowed from family in the last 12 months, under £250. The teal is over £250. In both cases, that's a pretty big segment of people saying they were borrowing small sums of money. We've done quite a lot on friends and family borrowing and about unregulated borrowing more generally, and there's a video on our website if you're interested in finding out more about that. You do, though, have to listen to me in that video. In addition to this, we've spent some time recently talking to about 100 borrowers in the last 6 months who borrow small sums of money from 10 different lenders up and down the country. And in those sessions, many people have been telling us that they prefer not to borrow from their mum or their granddad or their mate if credit was more available to them. Can we go to the next slide, please? So, not everyone on this call will agree with this slide, as this identifies the reduction in legal credit from home collected and high cost short-term credit companies in the past. Well, it covers the past 5 years. These are FCA figures, but what this shows you is that both of these types of lending has been significantly reduced. Between 2019 and between 2025, there were 3.5 million fewer loan agreements written. That amounts to a total value of a reduction in lending of £1 billion. Now, whether you believe that the reduction in this type of credit, home collected and high cost, whether you believe it's a good thing or a bad thing, it is a thing. And not having it does mean for some people in some situations that they can't access small sums of money. It's what Mark was hinting at. They can't access small sums of money in a regulated way. Now, buy now, pay later, and Kate touched on this, buy now, pay later is probably picking up some of this. 2 of our surveys in 2025 said that a quarter of the population were using buy now, pay later, or I think it's now deferred payment credit in the DPC. In our research, like the FCA's, we are finding that vast numbers of people will likely miss out once regulation day, as it's called, happens for firms in July. The next slide is the last slide, I think. And this is a pretty alarming stat from our research last year. We're about to repeat this research with a new survey, only this time we're going for 8,000 adults. So we asked 2 questions last year on whether the individual had personally used an unlicensed lender or loan shark in the past 12 months. Again, the orange is the piece I'm going to draw your attention to. We asked whether you had personally used an unlicensed lender or loan shark. We also asked 2 questions. The second question was, have you or someone in your household used this type of lending to the best of your knowledge? On both occasions, the answer we got was just under 4%, rounded to 4%. So we clearly believe from a number of sources that there is evidence that people need small sums. People are asking for small sums. People are often not getting small sums of money. Sometimes this leads to suboptimal choices that people have to make, or indeed more unwanted or exploitative routes to get to solutions to their problems. Like all the things we've been saying, it doesn't work for everybody, but the need for mainstream to become more engaged in this space seems pretty evident. There's more on our website about all of these research pieces. Thanks for listening. I think I'm passing back to Deanna.
Thanks, Neil. I think that paints a really clear picture of increasing demand and a shrinking supply is not the 2 directional things that you want to see happen. And I guess on that, what we want to talk about is we know that there is this big issue, and the key point is, what are we doing about it? And that is why we've launched the small sum lending pilot. So I'll be telling you about what the program is and how to apply. So the small sum lending pilot is a pot of funding that we've made available to support mainstream lenders in increasing access to credit, so stepping into the market of serving smaller sums of credit, predominantly lending below £1,000, but also importantly serving customers that they haven't previously served. What we're seeking here is to enable access to finance and to increase participation from borrowers and enable them to move on to mainstream finance, but also importantly, cheaper cost of credit over time. What we're doing to support lenders in that is we're making up to 25 million in funding available as part of the pilot, with possibility to extend that funding in the future, up to 10 million per lender. And we're seeking proposals that can evidence scale and can evidence innovative thinking and innovative ways of serving customers that have typically been excluded. What we're asking is that lenders are falling into and are fitting into the eligibility criteria that we've set for this pilot. That eligibility criteria includes, and is listed on the next slide, and includes a minimum commitment to deliver at least 15,000 loans, a banking license or evidence of significant scale, and by that we mean lending books that is in the size of £1 billion and above, targeting customers that are not typically served and being able to evidence that new customers are being served as a result of this intervention. and showing a pathway over time that migrates customers to a cheaper cost of credit, that enables them to access a cheaper cost of credit than they were able to previously. The reason for some of this eligibility criteria, as mentioned, is we really think this specific intervention and this specific pilot needs scalable solutions. It needs some of the large mainstream lenders who can commit to delivering a huge number of loans to be able to come to the picture. And so what we're looking for is lenders that are able to offer that. Beyond the funding that we've made available, we're also offering other support that is available to those that participate. So the support that is available includes support from a Fair for All finance team who've got support and expertise in proposition and delivery. We're supporting with the impact valuations around those that deliver this pilot to try to understand how we can drive good customer outcomes and the impact of the intervention, not just societally, but also at economic level and the contribution we can make to the economy. As mentioned by the FCA team, there is support from them in light of trying to work on a well-functioning credit market and opportunities for lenders to apply for the FCA sandbox, which has been resourced to support any of those lenders that are willing to and interested in applying for the pilot. In addition to this, also ClearScore will be offering support on the distribution of small sum lending to their 16 million adults that are available on that platform for those that are interested in taking part in the pilot. So I think what you can see here is a really well thought out intentional package of support for lenders who are willing to make a large scale commitment to trying to address the issue and trying to work with us on increasing access to credit to millions of people who can afford the credit and who can borrow responsibly and just need a chance to be able to access mainstream lending at a cheaper cost of credit and with other support measures that are in place for them to increase inclusion overall. With that in mind, I think we are going to step into our Q&A and we've had a few questions come through as we've been going through the presentation. We've collated them all and we'll be answering them now. I will also just mention that the copy of the slides that we've gone through today will be made available as well as a recording. So for those of you that would like to watch it or would like to share with colleagues, etc., you will be able to do that. And I think if we go to some of the questions that have come through, perhaps I will go firstly to questions in reference to the data and Neil, hopefully I'll come to you with this one. So we've got a question here about data, how customers and users are using credit, if we've got any insights on that, and anything else you can tell us about what we know about usage of credit.
Sure, thanks, Diana. Yeah, we do get insight into loan purpose, although sometimes with loan purpose you have to be obviously careful. People saying that they wanted the money for a holiday, and then discovering a holiday is not permitted. Oh, did I say holiday? I meant to say bunk beds. So we have to take some of that with a pinch of salt. But of course, there is both essential and discretionary purchases in all of that. We get in the feed that we get from Infineon, we get the reason that people had given for the loan application. There is, of course, there is a balance to those, from debt consolidation to car purchases to paying bills. So there is a range in there, and we have that information. We can share that. In our own survey, our own annual survey, we ask people what they use the money for, and again, there's a range of answers that we get from people, both essential and discretionary purchases. So yeah, some of that is likely to be for essential purchases, some for discretionary, but it's one of those things that's kind of slightly, as people will know, slightly inexact science about how we do that. Yeah, sorry, was there another bit, Deanna, that you wanted to ask me about that?
No, I think that's really helpful. Thank you, Neil. We've got another question here that I think I'll try and tackle and also come to others. So there's a question here around what engagement have Fairfield Finance and Treasury undertaken with credit unions in the US, and anything else that we can share about that. So I can say that probably a really helpful starting point is that the way that credit unions look in the United States is fairly different to what we're seeing in the UK, and we'd love to see a market that was slightly more similar to the US in that sense. So if I can give you an example, one of the largest credit unions in the US, it has nearly a trillion in assets. Now, that's not something that we're anywhere near for all the credit unions combined. In fact, very, very far away. So the picture when we're talking about credit unions here and the US is fairly different. And what's been interesting in the US, whereas lots of credit unions in the UK are already serving customers with products below £1,000, that isn't the picture in the US. So there's quite a lot of kind of differences in the way that you might look at those. That being said, we have spent some time with some of the credit unions in the US who have stepped into this market, and we've learned really interesting things from them about product design and best practice and how they've made the product work, that we've taken that into the design of this pilot. Kate, I wonder if there's anything else that you want to add on to that.
I think you captured it, Deanna. I mean, I guess the only thing I would add is that we are constantly impressed with what credit unions in the UK achieve. It's just our recognition that the scale of demand is so vast that we believe it's really important that mainstream providers, high street banks in particular, really also play their part in stepping into this part of the market. So that's why this scheme is really focused on those larger institutions. And we continue to support the growth and development of both the community development finance sector and the credit union sector. Thanks, Deanna.
Great, thank you. I think I'm seeing a few more questions come through and trying to kind of work out which ones are most helpful to prioritize. So we've got a few questions on eligibility of lenders, and so maybe I will just take a few of those. So from the perspective of eligibility, we've set out the criteria as being having a banking license or a lending book of significant scale. We're really keen to partner with banking providers. Part of the reason is because of the additional support and access to other products that build resilience that they're able to offer, such as savings products or insurance. So we believe there's a really interesting kind of cross-product proposition set that can be built up for clients to build resilience over time. But we also have made the scheme open and available to larger lenders who can evidence a cheaper cost of credit that can be provided to customers over time. So that's something to flag. And we've also got a question around Sharia compliant lending. We would absolutely welcome proposals from lenders who operate in the space and would be really interested to discuss more on the way that we do this. I guess what would be helpful, and maybe I think you alluded and mentioned on this a little bit earlier, Sophie, but perhaps again it would be useful to hear kind of Treasury's perspective on working with larger lenders and the impact that we think we can make and the reason this was chosen as one of the government's priorities.
Thanks, Diana. Sorry, there's a horrible lag on coming off me on this screen. Yes, so I think throughout the financial inclusion strategy, we are really keen to make a difference across the UK and really achieve impact at scale. I think on the credit side, that really means that we want to be sort of tackling all sides of the market and using all the levers that are at our disposal. So I think, as I mentioned earlier, that includes sort of strong support for the community finance sector, who we know have a really great track record in this space. But we're also really keen to explore what the potential is for larger lenders to operate in the space, because that is an easy and proven way to make a a large impact at scale in a short space of time, which as a government is always something that we want to see.
Thank you, Sophie. That's really helpful. We've also had a kind of another question in relation to eligibility and questions around whether this is something that we would be open to partnering on with online lenders. And I think, again, just to kind of reiterate here, so the focus for this piece of work is really partnering with large institutions who can deliver scale. So we're really open to kind of various conversations with lenders about innovative solutions and the way that we can support that. And I think probably this is also a useful time for us to share a quick slide about the way that Fair for All Finance works with the broader industry beyond small sum lending, just to kind of as a refresher of our commitments across other areas of work, including responsible commercial lenders. So here you can kind of see a very quick snapshot, and without taking too much away from the topic of mainstream delivery of small sum lending, we've committed funds and will continue to commit funds for our work with credit unions, for our work with responsible commercial lenders, for our work with insurers, and as well as our work with CDFIs. Whereas this specific pot of funding has really been carved out to focus on the way that we work with some of the larger banks and lenders and the work that they can deliver to address financial inclusion. And I've seen as well a question here on, again, on buy now, pay later and the data that we've seen on buy now, pay later. So potentially maybe I can come to you here, Neil, just to talk a little bit at a high level what we've been seeing about data on buy now, pay later.
Sure. On buy now, pay later, we researched it through our annual survey, but we also researched it in greater detail through a piece of research that we commissioned Matt Greenwood to undertake for us, in which he took a 6,000 person survey, found 26% of people had used buy now, pay later, and he split them through a Likert scale into 4 different categories and identified that it was likely that somewhere between, I think, 12 and 30% of people were likely to drop out of buy now, pay later post-July. Now, again, that could be a good thing or a bad thing. They could be dropping out because they've got, 10 products open and they're now being found out that there's 10 products open. But in the research, Matt had discovered that there were many people who would potentially drop out because of their debt to income ratio hadn't increased particularly significantly before or after using buy now, pay later, and that there was a potential that people who would otherwise be good payers were likely to miss out. So I'd commend that research. That's on our website. I saw something else about Klarna and others. We ask lots of questions about buy now, pay later. It's obviously very popular amongst customers throughout. But yeah, there's some specific stuff on our website about buy now, pay later research reports and others.
Thanks, Neil. That's really helpful. And just to kind of tack on that one, I think you've kind of covered it in the slides, but we've got a question again that's just asking, do we have kind of a rough idea of the number of people that are underserved? And I know there's lots of different ways that we look at this data, but is there anything that you can kind of bring to life again?
Mark in his remarks touched on the 3.2 million people who'd applied for credit and been refused. And we see that as well in our research. I need to go and just check the numbers to be sure I was giving you the right number. So perhaps I'll write that one rather than try and remember it off the top of my head. But there is no doubt that those people who are applying and missing out at the moment for credit, from our research, from ClearScores, from others, are those. There's no great surprise, those on the lowest incomes, those who are younger. Again, I think Mark touched on that, those who come from, who are most often in rented housing, particularly social rented housing, round up the usual suspects. That tends to be, again, those markers. We get some of that in the Infineon data. We don't publish all of the Infineon data we get, but we intend to publish it from in the summer, the most recent data. And based on what people are asking here, we'll also publish some information about what people are asking for, what their reason is for applying. But we'll also try and publish a bit more detail on who's applying and not getting, the characteristics of those individuals.
Thanks, Neil. That's really helpful. And then the next question that we've had come in is, we've spoken about how the banks in the US have been able to make this work and it's been commercially viable, and we talk about it being commercially viable based on some of the data that LEK published. And one of the questions we had is, if that is the case, then why aren't the banks in the UK doing it? And I'd love to get your thoughts on it. Not to say that you can speak on behalf of the whole industry, but Mark, I'd love to kind of get your thoughts on what are some of the challenges for lenders. And Kate, maybe you could come in too about why we might think that the lenders aren't doing this at the moment.
Yeah, thanks, Deanna. I mean, I think first of all, we appreciate there's a challenge for lenders in terms of who they lend to, and how much they've got to lend and where they make their choices on that front. So there will be some lenders who choose to focus on the most prime customers, and as you say, may then decide that those who are lower than prime aren't their target market. There are definitely organisations out there though who support these types of consumers, but you can see where the firms are having to make some commercial decisions. I think one of the benefits of this scheme is allowing firms to actually test that market, understand what outcomes you're seeing, and actually understand the performance of that loan book, which may make them more likely to lend in the future.
Thanks, Mark. I think the only thing I'd add to that is that there's always in any organisation, be it a commercial one or not, a bit of a fear of the unknown. And what we've seen through other pilots that we've run is that by providing a context in which people can try something out that they wouldn't otherwise do, there's lots of learning. So, for example, on the no interest loan scheme, Treasury very generously provided a guarantee for the first phase. Fair for All Finance has continued that into a second phase. We've got customers coming out of that with 96% customer satisfaction, and we've got lenders coming out of it saying, we didn't know that we could lend to these people, and not only did they pay us back, but their payment behaviour gave us enough confidence to lend to them again where there was no guarantee provided. And it's that journey from being excluded to having options that we're really wanting to secure through pilots like this, and giving commercial organisations an opportunity to test and prove what works is a great way to do that. So we do hope you'll join us in proving it at scale.
Thank you, Kate and Mark. I think that brings us actually to closing out remarks. I will just sort of reiterate, I think, especially because there was a really useful ending note from Mark and Kate, that the funding that we're making available, we're being really flexible with the way that can be used. We're open to proposals that use it as a kind of partial bad debt guarantee to test in the way that they serve new customers that they haven't served previously, or in supporting in operational costs, or to indemnify against any other costs that they anticipate might be coming. We'd welcome you to reach out for a conversation if you're interested in kind of learning a little bit more, but firstly and most importantly, to download the bidder pack, which will include the comprehensive detail about what the scheme is and how to apply, and that will be made available on our website within the next few days. Part of that will, of course, be making sure that you set out clear guidelines and guardrails for protecting customers in the way that they access this product. And we'll also be publishing our Code of Good Lending and Affordable Practice, which will be supplemented as part of the pack, and the application that you can make to us. Thank you very much to everyone. We will be collating some of the questions and thinking about the ways that we can kind of communicate more on the proposal. It's been great to see so much interest, and And thank you all so much for your time today, and to our speakers. We'll be in touch post the webinar with the link to the recording also. Thank you.